The Federal Reserve on Wednesday stepped up efforts to fight back inflation that's surging at the fastest pace since the 1980s. Taking note of price surges that have spread further and lasted longer than first thought, Fed Chief Jerome Powell said the central bank agreed to speed up the exit from its massive bond buying program by doubling the drawdown per month. The goal? To fully end by March 2022 the extraordinary assistance used to prevent the economy from falling into a deep recession during the health crisis. Powell says the economy is now at risk of overheating.
There's a real risk now, I believe, that inflation may be more persistent, and that may be putting inflation expectations under pressure, and that the risk of higher inflation becoming entrenched has increased. And I think that's part of the reason behind our move today, is to put ourselves in a position to be able to deal with that risk.
Wednesday's decision to more quickly scale back bond purchases is widely seen as a first step towards eventually raising interest rates. The Fed kept its key interest rate near zero on Wednesday, where it's been since March 2020, but policymakers indicated the era of record low interest rates will soon come to an end.
With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. All FOMC participants forecast that this remaining test will be met next year.
Fed projections released following their two-day meeting predict 3 rate hikes next year, which matched market expectations and sent stock prices higher. But there are a few wild cards which could ultimately determine when and if all those rate hikes will be needed. Powell says he's keeping an eye on what happens with the health crisis, which could slow economic growth like it did earlier this year, or lead to an even tighter labor market, which could push wages up and prevent inflation from coming down.
Lowe's was riding high. The home improvement retailer's shares surged as earnings trounced market expectations amid soaring demand for tools and building materials, leading the company to hike its full-year sales forecast. But just 1 month later, a different picture is emerging. Lowe's warned Wall Street Wednesday that it sees same-store sales falling as much as 3% next year. It also issued a revenue and profit forecast for the full year that fell short of analyst targets. Lowe's chief financial officer said Wednesday that the home improvement sector would likely shrink modestly next year, noting that the industry had benefited this year from higher inflation and government stimulus. The announcement signaled that the surge in demand for its products sparked by the health crisis would finally wane. Americans might be spending their money elsewhere, instead of on paint, tools, and gardening equipment. Lowe's shares, whose 58% appreciation this year vastly outperformed the broader market as investors bet on a strong holiday season, fell at the market open Wednesday before bouncing back.
Australia's Qantas Airways announced Thursday it's switching from Boeing to Airbus as its preferred supplier, in a major win for the European plane maker. The airline said deliveries would start in mid-2023 and continue over the next decade, replacing an aging domestic fleet of Boeing planes with more eco-friendly aircraft. The announcement caps a successful week for Airbus, which also locked in an order with Singapore Airlines and looks set to finalize another with Dutch airline KLM. Losing Qantas deals a big blow to Boeing's 737 MAX, interrupting a strong sales run since the jet was cleared for flight late last year following a safety ban. Boeing, which will only continue to supply its 787 Dreamliners, said it was disappointed in Qantas's decision, but that it looked forward to continuing its decades-long partnership with the airline. Meanwhile, Airbus said it was honored by Qantas's selection. In a statement, Qantas CEO Alan Joyce said he was not concerned that the airline would grow overly reliant on Airbus, weakening its ability to play the manufacturers against each other for better pricing going forward.
American consumers tapped on the brakes in November after starting their holiday shopping earlier than normal. Retail sales rose a weaker than expected 0.3% last month, according to data released Wednesday by the Commerce Department, following an upwardly revised 1.8% gain in October. Sales have risen for 4 straight months, fueled by government assistance doled out during the health crisis. But economists say there's a downside to all that stimulus. Demand is surging, outstripping supplies, resulting in shortages for items such as motor vehicles, furniture, and electronics, contributing to an inflation surge not seen since the 1980s. Calls are growing for the Federal Reserve to step in and use monetary policy to slow down the price spike. Even though consumer spending is responsible for nearly two-thirds of all economic activity, November's tepid retail sales figures were unlikely to ring alarm bells. With only weeks left in the fourth quarter, consumer spending is already tracking above where it was last quarter, and economists predict the economy this year will finish strong.